As we're with Stanley Toy Company here in 1320, and they're kind of giving us some totals associated with 1,420 toy flutes. We have some raw materials and we have some direct labor, and again, those amounts I put in green because they're given to you. But I want you to take note in this problem particularly that overhead is applied with some of our cost based on machine hours, and some of our overhead is applied based on how much direct labor we have. So we've actually got two different ways of applying overhead. So what the author is trying to do here, guys, is bring you to something that is called activity-based costing. So understand that the machine hours and the direct labor hours are the cost driver, which drive these overhead costs. So they tell us the 60 times 720. In other words, they use 60 machine hours for it, and 720 is given to us per machine. So we calculate this number 432, and then we do the same thing by multiplying the 612, which is direct labor, at 250%, which is what we estimate that the cost is going to be, right, based on a certain segment or a certain section of overhead, the ones that are driven by that cost. And that we come up with 1,530. And then we come up with a total manufacturing cost, and we divide that by the 1,420 units to get that per unit amount. And then they actually tell you that this amount is produced, but this amount was sold, so how many are left? Well, you come up with 110 units. And if you multiply that times the 240, then the ending inventory value for these toy flutes is $273.90. Now, know too that a manufacturer that makes toy flutes makes other toys as well, right? They always make other toys. So this is something I want you to realize is focused on a particular toy. And they may have 500 or even 5,000 different production runs on other toys. So this overhead applied, this cost that we're applying then to maybe based on machine hours for several different products, right? or direct labor for several different toys. So we're using maybe the same overhead applied rates to basically apply overhead to all of our toys. But in this particular case, we're just focused now specifically on a batch of toy flutes. But it could be this is the number ending inventory value, times 5,000 other toys would be their total ending inventory. So I just want to kind of give you that perspective as you're looking at these problems, because these are micro problems, not macro problems at this point. We're looking at per unit amounts, or per batch really, and then we're breaking it down per unit. But let's look at 1321 here. Now remember I told you that we have the word absorption. We mean that there's just some fixed cost in there. And so in 1321, we've got Wool Creations that manufactures wool sweaters, and the costs incurred in making 9,000 sweaters is going to be $11.60. So I'm going to put that amount here, and then they ask us, well, calculate the variable amount. And so if we were to take remember they give us this 22,500, and we divide it by that 9,000 that we made. And remember that this is an amount. This 22,500 is an amount of fixed total amount. So we're just simply dividing by the units to get 250. So if we take that fixed portion out of there, then we actually come up with a cost per sweater of $9.10 if you take out the fixed costs. And that's all they're asking you to do. If you take 1,600 sweaters, which is the amount they gave you in B, times that 250 that you came up with, then we understand that $4,000 more cost is going to go to the income statement under absorption costing than under variable costing. What that means, guys, is when you cost your cost of goods sold, you can do it by just using variable amounts, or you can use a portion of fixed amounts. So when you apply that overhead, then you can kind of isolate, if you will, the fixed costs, and you can just basically use variable costing to cost your goods, or you can use a portion of, right, the fixed cost as well. So all they're asking you to do here is to recognize that a portion of the cost is actually fixed, and they're making you calculate that. So if we have a total amount of fixed cost, and we have a total amount of variable cost of $9.10, then we can put that here in a linear formula that they call a cost formula. And it's just kind of put in a linear format here, see? And then we'll give you one more of those problems. We'll take a look again here, and we're just calculating the same way the fixed cost out of there, because they give us this 42,500, and we're dividing it out, and we're getting a variable cost per calculator, which means that there's about $3,145 more that's going to go to the cost of goods sold under the absorption costing than it would if you use just variable costing. So remember that this has an effect on your gross profit amount. And remember too that this is something that analysts look at and use, but also note that industries, it depends on which industry and what they do, like across that industry, as far as whether or not they use absorption costing or they use variable costing. If a certain industry uses variable costing, then all industry financial statements should use variable costing. It just depends on the industry. So that's what kind of changes here, guys. And that's why they want you as an MBA student to be aware that there are some fixed costs that kind of float around in these per unit amounts, and that we in this chapter really is all about isolating, remember, cost for identification and differentiation. And so in accounting, we take these and separate them in order to make decisions about those products. So this author, remember, in 1320 is bringing you toward our next big problem, which is activity-based kind of costing problem. And this is kind of just a little taste of that.